This is Miltos Savvidis, and I'll be going through my weekly trading roadmap for the week starting the 23rd of February 2015. So let's get started. So over the weekend, actually Friday, late Friday, we actually had some news regarding Greece. So let's just see how that's going to affect our trading for the rest of the week, particularly Monday. So the news was Greece had reached an agreement to extend their four-month financial bailout with the Eurozone. Obviously, there was a lot of speculation going into this. Some market participants being a little bit hesitant to put on some risk on positions just because of the uncertainty going forward. There's a lot of comments being thrown around, ECB preparing for a Grexit, German-led bloc saying that they're willing to leave let Greece leave the Eurozone, so on and so forth. So there's a lot of hype and tension building up, but really we actually got some sort of deal, some sort of agreement, something to move forward, something to move forward to, something to pave the path going forward. So some of the uncertainty was just shifted off the table now. It's not concrete. Obviously, this is just the first step, and they're going to have to move forward with further talks, but it is a positive. So, on that news, we had a couple of risk-on flows, particularly DAX, Eurostoxx had some decent moves to the upside. The Bund reversed its whole day to the upside and moved and closed much lower. And I think particularly with the way the Bund market structure is set up now, we've got some interesting opportunities, I think, even on Monday. So from a data point perspective, we have the German IFO, which is coming out tomorrow. I think that could be generally a good opportunity on the Bund, given the context as I just said. Now, why do I think so? If you look at the market structure in the Bund, and I'll just zoom past some of these charts. I've got the Bund right in here. So this is a Bund weekly chart, as you can see in here. The Bund, the way it's been forming this formation in here, it's very coiled. A lot of energy has been building up in this area. As you can see, there's one big week in here. That was the week after the ECB announced QE, and we've had now three weeks that are in just within this larger weekly range. So at the minute, we've got this bit of a pattern. We have some sort of structure that we can lean on. What's really key is that the market couldn't really get above this area right in here. So for me, it's quite key how this market's going to react now. Obviously, Bund had its options expiry on Friday, which is very interesting for me, particularly because if you saw the price action in the morning, it was holding relatively bid above the 158.50 mark. And the cash close, which is always a very good reference, comes in at the 158.78 level, if I'm not mistaken. It's quite far off from our close now, 158.37. But let's just take a look at the market profile structure in order to, deduce where we can see some areas for potential entries. Now, at the minute, the context obviously coming into Monday is rather bearish, just because of the reversal we've had. So the day on Friday was rather bullish to the upside. We had quite a nice move to the upside with the open at the low, and then towards the latter end of the day, once we got the news, the Bund took out that area and flushed a little bit lower to the downside in aftermarket hours. What's key for me now, we have this IFO print coming in tomorrow. I think it's usually early, around 9:30, if I'm not mistaken. What's important is these areas in here. You can see here, there's the value area low, the weekly value area low in here, and the weekly value high is just a lot higher in here. But what's important is to see how the market's going to be reacting around these areas. So essentially, what you're going to be looking at, obviously these are your 32s just nestled in here. Now a little bit higher, I think these are If I'm not mistaken, it's the 55s. It's the weekly value area low. But what's rather important is to be looking at your 50s because of the options expiry. Now, having said that there was someone putting a floor in the market around that area, it's quite intriguing, um, because if someone was putting that floor in and was buying that up quite aggressively, come the next day, usually that person or that party tends to liquidate quite heavily when it gets to those areas again. Now, um, this is actually not, I think this is actually the 44s if I'm not mistaken. The value area low is down here, 44s. I can't actually see the level here. I should have put it in. It was my mistake. The 50s actually comes quite a bit inside the value area, but that is going to be a very key level. I noted it just in here. That's going to be quite a key level for me. Just because, like I said, those options expiry traders, if they have to liquidate come Monday morning, which we usually do see, once it gets to that area, if we do see a seller come into the market, that could be very, very crucial. Now, to see if this market could actually hold a bearish tone from Monday, Tuesday, and the rest of the week, what I would be looking for is this market to start filling in some time and volume value in these areas where it actually hasn't shown any interest. So every time we've come into these areas below 32s down to these 18s, which we would be expecting some stops below here, we've always found a bid somehow. Hasn't particularly auctioned off here. It's just run out of energy every time it comes here. There's no particular paper interest in selling. So if we do actually get some sort of filling in here and we can actually breach convincingly back into this value area, well then there's a lot of scope for some moves to the downside. I know traders last week were looking for that break to the downside, but we didn't actually get it. So it's going to be quite interesting to see how this pans out. Now, what I was actually trying to get to with the IFO is that notoriously this figure usually it's a good fade. Now, I remember a scenario about 2 years back. I was trading this figure near all-time highs again. This was just before we had a pretty strong sell-off in the Bunds. Now we were trading near all-time highs, and the Bunds had come off on a similar market structure. The only difference was that the previous day we'd actually punctured the all-time high and then reversed. And then on the day we had the IFO, which was the very next day, we had a weaker print, and the market blipped up into resistance and then sold off very, very aggressively. Now I'm not saying that that will happen, but if it does, be prepared for it because of the bearish context we have. And if we do get a weaker number, I know there's it's a twofold scenario, but if it does happen, sometimes you get some really quick moves on that. So just be very, very prepared and ready if that scenario does pan out. Obviously, you could get a better number and it just moves lower, and that sparks gives a catalyst for a move. Or we could probe lower and find a bid again. I mean, we still do have buyers in this area. By no means is this a bear market, but we're seeing some signs in the price action that maybe this wants to take a bit of a breather. So just keep an eye on that going forward. Looking at just real quickly, I think I haven't finished today. We have the ECB's merge talking. Also, I think quite early in the morning, so just keep an eye on that. Looking quickly at the Eurostoxx and how that is panning out for the week ahead. Last week we went through how we'd come into this area, this pivotal area in here. We actually did see a reaction earlier in the week. We had a move down into these areas, but actually found a bid. And obviously later in the week we pushed a lot higher, closing the week very, very strong. So at the minute where we're trading, there is scope. I think again we could see a little bit of a pivot area in here, so maybe there could be early Monday, Tuesday some profit taking. Just be wary of it, and I'm noting this only because if you take a look on, and I posted this chart twice there, if you take a look here on a weekly market profile, this is where we closed. Obviously we had the market move late Friday night, after hours, after the EU close, the cash close. Now, what's very important is that if we open, in which we most definitely will, 95% will open outside of this value area, we're opening outside of last week's balance. Now, what you have to bear in mind is that the majority of the volume and the value is found here, and the market's moved up on a lot of thin air. And when I say thin air, I mean the market actually hasn't built any structure for it to lean on. So the way it is right now, we've moved up, we've got a lot of thin air below, and before this market moves higher, I'd imagine it would want to find some flooring, something to lean on, something to push back on. Now, come Monday, come tomorrow, we could actually see, I'm not saying straight off the bat, but I would expect at least a move to come and test this value area. Now, that obviously is just a scenario. We could theoretically just push higher, just with a bit of good news. The market just wants to make its move. It's been waiting for this kind of good news for a while now. But under the scenario that we do start selling off, I'm saying this also for the younger traders, because I mean the more experienced guys, sometimes they don't just put all their chips to the table on Monday. But some of the younger guys, if you're trading this tomorrow and you feel like this is such good news, the market's technically fundamentally bullish, I just want to buy this anywhere, everywhere. Just be wary. There's a lot of air in this, and we've had this on a very low volume move. So if we do move lower, I would expect the first, port of call would be these 34.94s, just the high, the volume, sorry, the value area high of last week. That's just where the volume starts kind of tapering higher. So would expect some sort of reaction around this area. And obviously, if we do dip below, I mean, that's also a scenario. If we do dip below and start offering and finding value within last week's value, well, then there is scope, to find a way back in here, maybe even fill in this little area in here. That is a scenario, obviously. Just keep it in mind. But that's the current market structure. Up above that, if we do start building a bit of structure, then we can start, exploring new areas to the upside. So moving on to Tuesday, we've got German GDP, European CPI. These are both final readings, so I wouldn't be expecting much volatility on that. With the U.S. consumer confidence, I'd be expecting this to start. I mean, as we've seen, retail sales, consumer confidence. These figures that pertain usually to the consumer of the U.S. I think these are going to start becoming just a lot more pertinent to the context right now. With regards to central bank policy, we've got the ECB's Draghi speaking on Tuesday. The main event, I think, of the week would be the Fed's Yellen is testifying at it's the Humphrey Hawkings testifying to the Senate banking panel on Tuesday. She's also testifying on Wednesday. I would imagine that the first one would probably be more important, but I could be mistaken on that. Anyway, I'll give the analysis for the Tuesday one in any case. So given the recent dovish FOMC minutes, which we did get some nice swift moves in the bonds and the currencies, we saw some dollar weakness, we saw some some general strength in the the Tnote or the Treasury complex. And I think the market tried to actually start scaling back some of those hawkish bets that we saw after those really strong employment numbers. However, I think those hawkish bets were kind of reinitiated, and I'll take a look at that in a second. So what's really important for me is obviously you want to be looking at these two scenarios. It's just like I think it's just a two-way coin basically. It's if the Fed chair reaffirms the dovish tilt, we could see an unwind of these recent hawkish bets, because obviously we had those FOMC minutes, but the FOMC minutes were pertaining to a meeting that was actually before the jobs numbers had come out. So maybe some of the smart money actually started, reinitiating and taking advantage of that. But then again, if we get Yellen leaning more towards the upbeat jobs numbers, and does not rule out a June hike, well, that would be pretty big. And the market could continue its recent moves, bonds to the downside, um, Euro USD, obviously, um, to the downside. Now, I think what I've just mentioned, obviously, I've made that very clear. The focus should be on bonds and currencies just because we've seen those being the best to hit, the best to get that initial influx of flow and volatility. And particularly, if we take a look at the US Treasury, this is the way it's setting up for the week. Obviously, this is a daily chart. I don't know what this is going to look like by Tuesday, but I wouldn't imagine it changed too much. What's important to note is that you see here this candle, this red candle to the downside is where we had the FOMC minutes. The yield dropped obviously as the T-notes rallied. So we had that bit of profit taking on this very, very aggressive move that we've seen ever since those jobs numbers. Um, and the next 2 days actually, we've given back all or most of that. We've pretty much, closed very close to the area of the open of that day. So it's interesting to note that just because we found a bit of a floor in yield here, we've moved back up. So the bets are still on. That's kind of why I was saying, given the context of this, if we actually do see something hawkish from the Fed come Tuesday, well then there's going to be a fairly big move, I'd imagine, just because we've got this at the minute. We've got a 3 bar, so this day is within the previous 2 days range. Now, if we do post another day within that range, then there's going to be further scope for an explosive move. So just keep that in mind, bear that in mind. I think that's a good little scenario to keep in the back of your head, just in case we get something that's quite big. So, I think another space to be looking at obviously is the dollar. If you take a look at the dollar just in here, you can see we've had just a monstrous move through late 2014 into 2015. But 2015, we've pretty much just been consolidating. This is a weekly chart, as you can see here. But we've coiled quite a bit now. So we've had this week. Well, this week was inside this 2 weekly range, and this week was inside this 3 weekly range, and now that week, last week, is within all those ranges. So at the minute, we've coiled quite a bit. Now, bearing that in mind, you probably want to find the currency pair that's going to give you the biggest bang for buck. Now, given that the euro dollar is looking a little bit more bullish just because of that small reversal we had on Friday, given the pound being a lot more firm after some of the the rhetoric from the BOE, I'd say looking at the Japanese yen, the dollar yen, is still my favorite. I think to trade if we do get a hawkish Fed, just because of the structure at the minute. So if you take a look at this, we're looking at this a week ago, this little triangular structure. We've broken out, false broken out, and we didn't actually get that follow through to the downside that we were expecting. So this has actually held a little bit firm. Last week, okay, it hasn't actually shown us a lot of initiative, but the way this is structured, again, we've got 1 week within the last 2 weeks range. So a bit of a call just at a key inflection point. So where we're opening now is still quite outside this structure. So given a bit of impetus, given a little bit of a catalyst, this market could start moving further up. This structure and the context of this market over the past year, 2 years has been very, very bullish. So if we do get something dollar bullish, given the structure just on the dollar index, this is kind of this has got that confluence you're looking for. This has got something that that is quite interesting if you're looking for something explosive, something to move quickly. So keep an eye out on that. That's going to be quite an interesting little pair. So Wednesday, we've got HSBC China Manufacturing PMI. That's a preliminary read. I'd be taking a look at that quite keenly, just to see if we get any further contractionary Chinese manufacturing PMIs, which would be risk off, and you'd be looking at your coppers and obviously your equity markets to see if there's any sort of reactions to that come Wednesday morning. Then we have the DOE Crude Oil Inventories. This is very pertinent just because the last week's API was very high. We were expecting something like 3 million barrels of stockpiles. We ended up getting 14.3 or something, very high. I think it was the highest since like 1982 or something. But the DOE that we got on Thursday of last week, because it was moved a day forward, was came in at about 7 million. So still pretty high, just not as high as the APIs. But keep an eye on that, because the API oil inventories, we had a pretty sharp market reaction. And if you take a look quickly at WTI crude oil, we were talking about this structure last week. We saw that we're making lower highs and higher lows consecutively, and the market's been coiling. Look at the volume that we've been doing. I'm pointing this out again. We've done a lot of volume in this structure, so this is exactly what you want to be looking for. If we see a move outside of this barrier, we're just slowly, this is convex, it's moving inwards. So the more volume gets done, the more trading we get done, and the more narrow this range becomes, the more explosive the move will be. Now mind you, we had this pop up right in here. We had the oil inventories, the APIs, which came out pretty bad, so we had that sell off the very next day that came back into this structure, and inevitably we tested the other side. And I mean, almost to the tick. You could see this is the fourth time we've touched that support trend line. So that's very, very pertinent going forward. Keeping a very close eye on this. Um, if we get um, some higher stockpiles than expected, and continue in the trend of oversupply, which is becoming more and more of a concern in the investors' eyes, and we could just see a break through the structure, and it would basically negate this sort of inverse head and shoulders that we're building. Now I don't necessarily like this structure that much anymore, just because you usually like to see one nice big shoulder build. This is building a lot of energy in here, and obviously the context is quite bearish. But the caveat to that is just the fact that since we've come off the past 3 days, 4 days, just look at the volume right here. That is, the age-old saying in the markets is that the price never lies and volume never lies. And since we've had this move down, we haven't actually seen a lot of volume being done. Now, if this market did actually want to make a strong move to the downside, I would expect the volume to be increasing as the price moves lower. But actually, it seems like that's sort of dying down at the minute. Now, we're just going to have to see how that develops. Obviously, if we do get a break and volume re-enters, then you go with it. But just keep that in mind. Volume has sort of been on a downward slope ever since we've moved down from the top end of this. So just keep that in mind. On Wednesday, again, we also have Fed's Yellen testifying to the House Financial Services Committee. Whatever I basically went through for Tuesday applies for Wednesday. If it's not said in Tuesday, then you'd be looking at Wednesday. Obviously, maybe nothing might be said in both days, but just keep an eye on both days. ECB's Draghi, again, he's also testifying to EU Parliament, so keep an eye on what he says. Looking out for Thursday, we've got UK data, we've got UK GDP, which is a preliminary read, US CPI core month on month, and the US durable goods. With regards to central bank policy, we've got the Fed's Lockhart, he's a voter, middle, ECB's Lind, which is a leading dove. So keep just looking at our market structures that pertaining particularly to the UK numbers. We went through some US markets already. To look at the cable, so the way the cable structure, we've looked at this about 3-4 weeks in a row now, and this is a daily chart. So this is the inverse head and shoulders that we looked at 2 weeks ago, coming into the QIR minutes, the QIR, the quarterly inflation reports from the BOE. So this was the reaction, obviously, that we had, and the market has, I wouldn't say has definitely reached its target, because we had about a 320 pip target from here to here, measured from around this area, which would have comfortably put us at 155. We haven't quite reached it, but I mean, given about 5 to 10% tolerance, that's basically reached your target. If you were trading a swing trade or a long-term trade, I wouldn't be, as you would say, a dick for a tick. But in any case, as the market's setting up right now, we've got this bit of a, again, um, this daily candle within the last 2 days, and also obviously this is also within that, but we've got a bit of a consolidation. So the market is at the minute waiting for some sort of data, um, to reignite some flows either on either side. Now, obviously, given the short-term context, we're quite bullish on the short term. Medium term, we're bearish. So you have to keep that in mind at all times, because if we do, let's say, get better GDP data, and the market just spikes up, makes a move, trends higher, and reaches this 155 mark, keeping in mind the medium term, maybe we get a very strong sell, from this area. So just keep that in the back of your head. On the contrary, we could get very bad data, and the market sort of takes out this low in here, which I believe we made. This was the FOMC minutes day, so taking that area, maybe we could see a few stops, and a rollover. So that's the pertinent market for Thursday. Quickly looking at Friday to wrap this up. German CPI preliminary. I wouldn't be expecting huge amount of volatility around that, but keep an eye on that to see how that develops. Um, U.S. GDP, U.S. core PCE, and U.S. Chicago PMI all on Friday. From a central bank policy perspective, we have the Fed's Mester, which is a non-voter and a leaning hawk. ECB's Constantia, which is leaning dove, and Fed's Fisher, a voter and middle. We also have month ends on Friday, so keep an eye on the flows. Last month was obviously a very good month end from all aspects, bonds and equities, hoping that this month is just as good. So you would definitely look through your city month-end extensions notes that they had sent over, to see how you would trade your bunds, for example. I won't go through that because that's just a little bit long-winded for this video. From a risk and money management perspective, as you can see very clearly, I've stated out the inventory and risk of the week, their relevance, and my theoretical risk allocation for each day. So I've put in 15% for Monday, 25% Tuesday when we've got the Fed's Yellen. I would have put a lot more here, but being as we have month end, I've put an equal weighting on Friday, and then Wednesday and Thursday. Wednesday, obviously, we've got a bit more relevance, so I've given that 20%. Again, just say this every week. This is my risk plan, shouldn't be your risk plan, but just to give you an idea of what I would be looking at. Now, you should always have your risk plan around what makes you money. Great. So thank you guys for listening. That was my weekly trading roadmap. Hope you guys can profit from any of this that I'm sending over to you guys. And good luck trading for the rest of the week. Take it easy, and we'll speak on Friday. Bye-bye.